Okay, I'd like to call this June 14th, 2022 meeting of the Financial Audit Advisory Committee to order. This is Matthew Johnson. I am chair of the select board and as a consequence, the chair of the Financial Audit Committee. I'd like to begin, since this is a remote meeting, to make a roll call of participants. So is Wendy Ravelli here?
Yeah, I'm here.
Okay. Court Booth?
Here, thank you.
Arthur Fullman?
Here.
Myself, Matthew Johnson, and then Carol Wilson, and I believe she is not here.
Correct.
Okay, so we have 4 out of 5 voting members. So then let's begin with our first topic, which is the review of the minutes of the last meeting and approval.
So just a comment, I read them and they seem to be completely in order and reflect our meeting actions.
I agree with that.
So I can make a motion to accept the drafted minutes of the meeting of October 19th, 2021.
I'll second.
Okay, so roll call vote. Ms. Ravelli?
Approve?
Mr. Booth?
Aye.
Mr. Fullman?
Approve.
And myself, Mr. Johnson, approve. Even though I wasn't present, the form looks appropriate to me. Okay, just 1 second. I don't have the agenda up in front of me.
You want me to bring it up?
Yes, that would be wonderful.
Okay, let me share my screen.
Had the minutes of the packet doesn't have the agenda at the beginning.
Oh, sorry. Can everybody see?
Yes, so let's move on to our second topic, which is the FY21 town audit. And we'll review the ACFR and management letter from our auditor.
Good morning, Scott McIntyre here, and also on the call is Sarah Kordak, together with a couple of our other staff members. We've completed our engagement of the town, and we're inches away from completing our engagement with the school district, which we'll talk about in a few minutes. But the second agenda item is all about the review of the town's ACFR. Previously was called a comprehensive annual financial report. The standards have changed, and so really I'm just pointing that out, that the name of the report has simply changed to the annual comprehensive financial report, or the ACFR. I'm going to begin, and Mary, if it's possible, I'm going to share my screen.
Yeah, you should be able to do that.
All right, I think you would have up our independent auditors report on the town of Concord's financial statements. I'm going to hit some highlights on that in just a moment, but most importantly, as I almost always do, is I start a conversation like this with letting you folks know how our audit went, and our audit of your financial statements went very well. And what that really means, in the most basic terms that I can think of, is that when we came in to perform our procedures, we found the books and records to be in good working order, and that key accounts were reconciled on a regular and timely basis, and there were no disagreements in how to apply generally accepted accounting principles between our auditing firm and the town. If those two things sound like required communication, they are required communications. And there's really a third issue that the auditing standards require us to communicate with those charged with governance, which was in Concord and Concord Carlisle's case, is we view as this audit committee. The third and the final thing really deals with accounting estimates that are in your financial statements. And there's many that are in there. But the most significant ones deal with 2 of the longer term liabilities that we'll speak a little bit about: your net pension liability and your net OPEB liability, and the related accounts, the related deferred outflows and deferred inflows, and obviously how these liabilities get allocated to the various reporting units in your financial statements. But there's also others in there, such as the collectability of receivables and the useful lives of capital assets and things like that. But nonetheless, the 2 biggest estimates deal with your pension liability and your OPEB liability. But I think it's always important to remind those charged with governance that you have professional actuaries that follow standards when it comes to performing those analyses and developing those liabilities. And there's a rather robust review of the assumptions associated with those reports that you obtain from your actuary, both by the town, and they're subject to auditing procedures by our firm as well. So while the numbers are rather large and considered accounting estimates, there certainly are standards and behind the work that the professional actuaries do for the town and helps you prepare these long-term financial statements. So with that quick introduction on the independent auditors report, nothing's new. Well, there's one small thing that's new here, but the good news is that, like in the prior years, we are issuing what is known as a clean or an unmodified opinion on your annual comprehensive financial report. I called it a comprehensive annual financial report for 30 years. So me making this change it's a little hard, but I'll get there. So in our opinion, based on the auditing standards that we followed, your annual comprehensive financial report is presented in accordance with generally accepted accounting principles here in the United States of America. So, generically, it's called a clean opinion. Technically, it's called a modified opinion. The one thing that's new is this emphasis of matter on the second page of the opinion. As discussed in one of the footnotes, you implemented a new accounting standard this year, GASB statement number 84. It brought into play what are known as custodial funds. Didn't have a super big impact on the town, but nonetheless, it is a new accounting standard that you did implement. Now, jumping ahead very quickly to next year, this whole auditor's opinion is going to look very, very different. It'll still be in all likelihood a clean or an unmodified opinion, but it will look very, very different next year because of the auditing standards that have rewritten this report to hopefully bring, or at least the standards setters tell us, to bring more clarity to the opinion itself. So I'm going to hop all the way over to page. Well, it's page 40 in the PDF of the packet that Mary had sent out, but it's the second page of your statement of net position. Now, remembering that there are essentially two sets of financial statements in your annual comprehensive financial report. There's a long-term perspective, which is what we're looking at right now on the screen, and we'll get to the short-term perspective, which is really the general fund, if you will, and we'll talk a lot about unassigned fund balance. But back on this page that I'm sharing the screen, this is the liabilities and net position or equity section of your long-term perspective financial statements. And as I indicated before, there are a couple of estimates in here, and they really are the two accounts that we feel should be discussed at this perspective. And that is your net pension liability and your net OPEB liability that I've tried to highlight here. A couple of things to note. One, I'm focusing on the governmental activities column. Certainly there are your business type activities that involve your enterprise funds, but I'm really going to focus predominantly on the governmental activities. Your net pension liability, as of the balance sheet date of 6/30/21, and technically it's measured at the end of the retirement systems year, which is December 2020, had a liability of just under $8.5 million. It's really important to note, I think everyone in the town knows this, your system is about 95% funded as of this date. So it's a very, very well funded system. And that $8.5 million net pension liability, relatively speaking, is one of the smaller ones we see in the Commonwealth. Now, again, I want to point out that it was measured as of 12/31/2020, so it doesn't include the investment performance of calendar 21 yet, nor does it take into consideration any of the investment performance to date in calendar 2022. And right below that is your net pension, your net OPEB liability with an account balance of just under $16.7 million as of 6/30/2021. Now, this account balance has seen a significant drop. A year ago, that account balance had a $38 million liability, and it's all the way down to $17 million as of 6/30/21. Now, in sharing the screen, I'm going to come back to this page and finish talking about it, but I want to skip over to page 91 of the report, which is page 104 of the PDF of the package that Mary sent out. And you can see here, here's the $38 million from the prior year, and it's down to $18 million. And of course, this is a combination between the total liability less the trust fund that the town has established, coming up with the net OPEB liability. And what really happened in fiscal year 21? Let's first focus on this middle column, which is the fiduciary plan net position. You contributed $4 million and you paid benefits. These are implicitly paid benefits of $2.5 million. That's a significant, $1.5 million cash contribution into the fund. In addition to the cash contribution, the portfolio earned $7.3 million. So the plan net position increased by almost $9 million from June 30, 2020 to June 30, 2021, pardon me. So obviously that almost $9 million in increased plan net position is going to help bring down that liability. But also the total liability itself came down about $11.5 million here, right here. That's driven by these three negative numbers right here. And in this case, the negative numbers they benefit your overall net position, because what happened is, based on the difference between the expected and actual experience of the performance of the health plan, the liability went down 11.2, almost $11.3 million. You did change some assumptions, which brought the liability down, and you really aligned the discount rate with the pension plan. And then you also had the benefit payments that bring the liability down. Now, right below this, and I'm not going to spend a lot of time on it because it's written out fairly well here and even more robustly in your actuarial report, but to fully understand what's going on, particularly with these two numbers that are helping to bring down that liability by almost $15 million, it tries to summarize things right here below this schedule of what's happened in your OPEB trust fund and your net OPEB liability during fiscal year 21 is really highlighted in this paragraph of print page 91 or page 104 of the PDF that Mary sent out. So I want to go back very quickly now to it's the liabilities and net position page of your long-term perspective financial statements. And again, we're focusing on these two account balances here. In our opinion, any conversation about a local government's financial position and financial statements need to entail something about the net pension liability and the net OPEB liability. But just to put things in perspective, I've already pointed out that the net pension liability, the Concord contributory retirement system, is about 95% funded, and your OPEB plan is about 62% funded. So, I mean, we work with a lot of communities in the Commonwealth and a number of what I would call your peer communities right along the 128 belt and what have you. And these liabilities relative to everyone in the Commonwealth are substantially lower. And they're on par or even more favorable than your peer AAA rated communities in your general geographical area. So while I'm focusing on these two liabilities, they're really relatively small compared to most of your peers. And I think the credit rating agencies would not look at these and see anything all too problematic. Now, I want to point out one more thing that just is, as these liabilities have come down, and each of them has come down from the prior year, I want to talk a little bit about these deferred inflows of resources. They're not technically liabilities, but they act a little bit like liabilities. Basically, the experience gains and the favorable investment earnings that have brought down the liabilities kind of create these deferred inflows of resources. Now, in essence, it's not an exact number, but over the next 4+ years, these $27 million in liabilities, again, they're not technically liabilities, but they act like liabilities, will be amortized away down to zero. Of course, there'll be other things that give rise to a deferral, but this $27 million will amortize away over the next 4+ years. And you have a real opportunity to take your unrestricted net position, which is in a deficit situation caused strictly by the pension liability and OPEB liability. And once these deferred inflows of resources amortize away, you have a real opportunity to turn that unrestricted, negative unrestricted net position number into a positive number. I just wanted to point that out, just so you may have a flavor for what's going to happen to this page in your financial statements in future years. Again, that negative number that I have highlighted there, I don't think any credit rating agency is going to have any issues with that because of the relative smallness of the two numbers that we've talked most about on this page, which is the net pension liability and the net OPEB liability. Let's turn the page.
Scott, if I could just interrupt on the topic of OPEB, that, I mean, this story is very positive, of course, for the town of Concord. One thing that we did identify, though, the magnitude on us is not as big in this past year, is that we do belong to a regional technical high school district, and that regional technical high school, Minuteman Tech, has unfortunately the opposite kind of situation relative to its OPEB.
Yep.
And while that is not technically part of our budget, we as a town are in effect on the hook, as you know, in part for that as a member of that district. So I don't know if those aspects, those encumbrances on us are dealt with in our auditing, but I just was curious about how those effects.
Yeah, that is a great point, and it's you know, I actually think the GASB is going to find a way to maybe you know, address the issue that you raise, because, well, while not directly a liability of the town of Concord, I'll use the term, and it's not designed to be a technical term. You have an indirect liability there that will, you know, cause future payments to that Minuteman School District likely to increase.
Yeah.
And I think you know, the GASB's been extremely busy. Just yesterday, they issued statement number 100, and honestly, it was like 9 years ago they issued statement 54. So they've been super busy. I would not be the least bit surprised if they're in the future, perhaps I know they have a statement that they're looking to create on the note disclosures. There's talk about them reducing the amount of disclosures, which honestly would be a very welcome standard for most people. But I think the subject matter that you raise will also be part of that standard, because what credit rating agencies want to know is what future cash obligations are local governments on the hook for. And while it may not be a financial statement, or pardon me, a balance sheet liability, it will impact the future cash flows of the organization.
Yeah. Okay. And then, I mean, by the same token, you know, we are entering into a regional dispatch arrangement with the town of Concord, and there we are an equal partner with Acton. And, you know, to the extent that they issue debt or, you know, have capital expenses, you know, that I don't know to what extent they're reflected in our audited statements.
Yeah.
I'm going to need to understand a little bit more about that in the coming years in order to see the relationship. GAAP defines many things as a joint venture. One would be a joint venture, which I believe in the Minuteman, you have a joint venture with many other communities with Minuteman, but there are also technical items such as a component unit to the financial statements, and the town and our firm will need to evaluate exactly where this
Yeah, and I do
falls.
believe in this case that the net effect should be a positive one on the town, in that there is state support for these types of arrangements. So,
Yes.
but I am curious about you know, as we get into more of these kinds of regional, you know, entities, you know, what does it do to our town's finances? So.
Yeah, and again, I didn't think about this when I answered or commented a minute ago, but I talked about GASB's busy schedule. And one of their newest standards is, you know, public partnerships and public-private partnerships. Very comprehensive standard that, you know, the types of things you mentioned probably fit into one of those buckets. There's the public-public, there's the public-private, there's a couple of other types of, you know, I'll call them joint ventures, but that's a technical term, but I'm used it in a very generic fashion. But all of these new accounting standards will need to be evaluated.
Okay, thank you.
I was going to go on to the fund statements for a minute, but I think I want to take just another minute and talk about these liabilities, because I don't want to turn to the page in your management's discussion and analysis, but your pension liability in particular is, as I said, it's about 95% funded. And I believe it's spelled out in your MD&A, but it's a huge report, so it might not get read. And I know it's been spelled out very clearly in your OPEB valuation performed by Stone Consulting. There is a difference between, when it comes to these liabilities, there is a difference between funding and accounting. What's in your audit is the accounting side of things, which is mutually exclusive. They're related, but they're not to be confused with funding. So why do I bring this up? I bring this up because let's jump ahead maybe a couple of years, and maybe your pension plan goes from a pension liability to a pension asset. Very, very, very possible. However, that's on the accounting side. On the funding side, you may still have an amortization schedule that you need to amortize with your annual contributions as are determined by PERAC. So I wanted to point that out and just let the committee know. It's probably something that you'll see come to fruition in a couple of years, is that there's a difference between the accounting side of things with pension and OPEB and the funding side of things. And up until organizations become, like you folks, closer to being fully funded, it probably hasn't been talked about enough, but I wanted to introduce that concept so that when it happens, you don't go, well, Scott, you're telling me we have a net pension net asset, yet PERAC's telling us we still have 3 more years on our funding schedule. There's a whole bunch of reasons for that, but that concept is very real and exists in many places in the Commonwealth now. With that said, let's go over to the fund basis financial statements. This is still, even with, GASB 34 has been around for 20 years, and pension and OPEB are now in the reports. Still, the first place that almost all readers of the financial statement turn is the fund basis balance sheet, and they focus on the fund balance section of the general fund. And very quickly, your total fund balance, where assets exceed your liabilities by a little over $38 million. About 12.3 of it is restricted. That's the pension fund that you have in your pension reserve fund that you have accounted for within the general fund. Your committed fund balance of $8 million. That's your various stabilization accounts. And this assigned fund balance of about $6.9 million. That's made up of 2 things: encumbrances, that appropriations that are carried forward into fiscal year 22. That represents about 4.9 million of this 6.9, and the other $2 million of it is money that has been appropriated for fiscal year, some of your free cash that has been appropriated for fiscal year 22. That leaves $10.8 million in unassigned fund balance. Unassigned fund balance is definitely the first place that almost all readers are going to turn. Now, it's remarkable similar. That account balance barely changed from fiscal year 20 to fiscal year 21. It's changed by just a very, very small amount of dollars. I wanted to point out one more thing, and with the screen sharing, I think I can do this relatively easy. The reason this account balance is significantly unchanged is you had very strong budgetary results. Go over to your budget versus actual page in your financial statements. The favorable revenues and the favorable expenditures net to about a positive $2.56 million. You transferred in $163,000 less than you anticipated. So collectively, this is about a favorable budgetary performance of $2.3 million. Normally, that would indicate that on fund balance would go up by about $2.3 million. However, as the town of Concord, as all communities do, and you've done it in the past, you used a certain amount of your free cash for, I just need to pardon me. I thought I could do this without notes, but let me just turn to a page so I can help hopefully make this a little more clear for you folks. Now, this $2.3 million in favorable budgetary results, when you add that to or combine that with the fact that going to take us to this section of your management's discussion and analysis. The unassigned fund balance changed by $119,000. That's what I was saying. It was relatively unchanged from the prior year. And why did that occur? It occurred from two reasons. The 2.3, I guess it's almost $2.4 million that we saw on the budgetary page just a moment ago, coupled with the fact that the town used $2.5 million of free cash for fiscal year 22. The favorable budgetary results of 2.4, less the use of free cash of 2.5 for the subsequent fiscal year, it's roughly a negative $100,000. That's what drove the change in the unassigned fund balance. I'm sorry if that got a little clunky. I thought I was going to be able to do that a little more smoothly. Let me just try to say that once again, because I think if you're focusing on the unassigned fund balance, the paragraph that I have highlighted up here is really important. It changed by $119,000 from positive budgetary results, which is a combination of favorable revenues and unspent appropriations, softened or mitigated by the town's decision, as most communities do, use about $2.5 million in certified free cash for fiscal year 22. So hopefully that I probably made that more complicated than it needed to be. But again, I want to go back to this particular page in the financial statements. And again,
I did have one question, which is that town meeting voted to reduce the tax levy, use free cash to reduce the tax levy by $1 million, I believe.
okay.
So where's the other 867,000 come from? How does that get?
Sure. I would have to look that up unless Sarah, you know it off the top of your head, but I do not off the top of my head, but I'll be happy to get that, look that up and share it with Mary, or Mary, you perhaps know off the top of your head.
Yeah, the 867,000, oh, go ahead, Carrie.
Oh, I was just gonna say, I could answer that too.
Oh,
So that is the prior year carry forward. That town meeting appropriated, because of the pandemic and lost revenue, we had a surplus in the prior year and we asked town meeting to carry forward.
Okay, so yeah, so that would not be a typical thing. Normally, we would see a round number there instead of that. In future years, let's say, because normally we would decide a fixed number as opposed to, because like you said, due to COVID, we had that special case where we just said, okay, we can roll forward this year, and we did.
Yeah, the use of free cash in that way is not typical at all. So
Right.
that we have it.
Okay,
Yeah.
that answers my question, because I was like, I don't remember 867,000 something.
It was a rollover what we can.
Yeah, okay,
Yeah.
thank you.
one last thing on the governmental funds page. I just wanted to point out, there's a separate column this year for your federal grants fund. Because of the size and magnitude of the activities in there for fiscal year 21, it meets the definition of what is considered a major fund, which means the balance sheet gets presented all by itself and not consolidated into this non-major governmental funds. I just wanted to point out that, it shows an unassigned fund balance deficit of a negative 1.5. It's really not, should not be looked at as problematic. Grant funds in general are expenditure driven, which means you spend the money and seek reimbursement. So in fiscal year 22, the money would have come in to essentially eliminate that accounting deficit right there. It's not meant to show that you've overspent any grant funds or anything like that. It's really driven by timing.
Well, and we've decided, I think, with the ARPA funds to spend them over the full 4-year period. So I don't know what would qualify as the sort of magnitude that would carry this, but we might see this column for quite some time.
You might, if particularly if ARPA goes, and I'm sure it did, into this federal grant fund. It probably will be, because I don't know, I can't think off the top of my head exactly how much cash you would have received, but
It would be
essentially,
like 1.4 mil a year for 4 years.
yeah, so that a lot of that money is going to sit on your balance sheet as a liability until you spend it. Just from a revenue recognition standpoint.
Yeah.
So the liabilities of the fund will probably remain high which, without getting too much into how to calculate major funds, is a high degree of likelihood that this fund will be considered major for a few more years.
Well, and there'll be infrastructure grants too, probably.
Probably, yes. One more page that I like to point out on the financial statements. Talked a lot about the solid funding of pension and OPEB. But starting here and going on to the next page is what are generally viewed as the amortization schedules of a government's long-term bonds and loans. And I wanted to point this out, and it goes on to the next page, and the same concept is the same. This page is the governmental activities. The next page is some of your various enterprise funds and some of your direct debt. But what's important to note here is that everything is paid off by 2031. And again, why is that important? Well, credit rating agencies like to see how much of your long-term obligations will be retired within a 10-year period. And Concord fits very well into that model that credit rating agencies have. So I always like to point that out when it's a very favorable, but it's really much more important for me to point that out when it's not so favorable.
Well, next year it's going to look a lot different.
Right.
Well, I hear somebody talking about schools. We had some internal training yesterday, and I brought this concept up, and there certainly are exceptions to the rule of thumb. If a community builds a massive new school and decides to pay for it over 25 or 30 years, well, yeah, the concept of how much you're paying off within 10 years, the math doesn't look good, but is it really all that problematic? No. Rating agencies notice those things. So that was all I was really wanting to talk about with respect to the town audit. Oh, I'm sorry. I wanted to go over a couple of management letter comments that we had. I come to the first page of our recommendations. I would encourage you, if you haven't, to read the opening report.
I just wonder if I should just notice that this is I think we're moving to the next agenda topic, right? The draft statement and management letter.
It's
This is-
part of that.
Oh, it's
same-
part of this. Okay, I'm just
same,
trying to
yeah,
understand
agenda
that. Oh,
item.
I see it. Instead of regional school
Yeah.
district. Got it. Sorry
This
about
is-
that.
No problem. This is still on the town.
It's the
Yeah.
problem of chairing the first meeting that I'm attending.
I'm not showing the opening letter, if you will, but it's important to read because it tells you a little bit about what we did, and just as importantly, what we didn't do. We didn't look at every single transaction coming through the books and records of Concord. But it also defines a couple of key terms in that opening letter, such as material weakness and significant deficiency. And again, the definitions of those are outlined in the letter. I'm not going to talk about them unless you choose to ask me to. That's because those terms, they're a little intimidating, and they're probably designed to be that way. The point is, anything we have here in our judgment is not considered a significant deficiency or a material weakness. These are some recommendations that we are making to streamline a couple of policies and procedures and the practices and the like, but none of these rise to the level of what is defined in that opening letter as a significant deficiency or a material weakness. With that said, our first and our current year, one of our only current year recommendation is to just improve the cash reconciliation procedures. You do a very nice job on a monthly basis, reconciling your cash. We did notice this year that investment statements were not included in this process. And as a result, through the audit process, there was an adjustment in the OPEB trust fund by about $1.6 million. So management agrees with our comment here, and going forward, we'll take the necessary steps to ensure that all bank accounts, including investment accounts, are included in the overall cash reconciliation. A couple of follow-up to some prior year comments, improve year-end cutoff procedures. Again, the community does a great job in its general fund, which is a budgetary fund, with cutting off, making sure all invoices or costs or expenditures associated with the closeout of one fiscal year are properly charged to the fiscal year and properly charged to the proper budget year. But as you know, your enterprise funds are and water in particular is not a budgetary fund. We did find, an invoice related to the water fund that was for fiscal year 21, but it was charged off to fiscal year 22 instead. And without that same clear and precise cutoff of expenditures, capital assets and liabilities in the water fund could be understated. So we're recommending that you apply the same very critical and robust cutoff procedures to the general fund. We're suggesting you apply them to the non-budgetary funds as well. Issue number 3 is to prepare for GASB statement number 84 and 87. I mentioned when we looked at the opinion, we had an emphasis of matter paragraph because you implemented 84. We implemented it through the audit process. There is still the town still needs to adjust some things in its accounting records to have the general ledger be 84 compliant. And the second issue is, or the second new standard, which will be effective for fiscal year 22, is statement number 87 that addresses lease accounting. In essence, the terms of capital lease and operating lease go away, and the definition changes from a very standard and traditional definition to something not so typical. And so there's a little bit of work that the community needs to do with statement 87 to search some of its underlying records. I'm not talking just about the general ledger, but speaking with your departments as far as what might be out there for lease payables and lease receivables. So there's some prep work, and we're going to be communicating with Concord and all of our clients in the coming weeks on statement 87. But there is some work for you to do because while capital leases have always been on your balance sheet, now the old operating leases will also need to be on there as well. So, and I think lastly in our recommendation is to align the encumbrance policy with the practice. We've talked about this for a couple of years, and as is noted in the first paragraph, your policy says that an encumbrance shall be for a specific purpose at some later point. That's what the policy says. The practice is not really aligned with that, where funds are carried forward without a specific vendor or for a particular purpose. And over time, these unspecified amounts have grown to almost $2 million in encumbrances. So the recommendation again is to align the practice with the policy. So, and lastly, sorry, there was one more. It deals with back in 2019. You implemented a new billing system with your utilities, CMLP, water and sewer, and there remains a small variance in each of the water sewer receivables that has been around for a couple of years that still needs to be resolved at some point in time in the future. That is a very, very quick walkthrough of our management letter, our audit process in the town of Concord, and your annual comprehensive financial report. So I will take any questions or try to answer any questions that you may have before going on to the next agenda item.
I believe, Wendy, that the utility receivables, right, are, well, I guess this is sewer and water, but I thought at CMLP, there's work on that, right? Reducing.
We had been, I think that was identified a couple of years ago, and I'm curious to know whether those issues were resolved. This does look like it's now water and sewer, so
Yeah.
moved from one enterprise fund as an issue to another potentially.
I do believe the issue with the electric fund is resolved.
Right.
Okay, thanks.
Yep. Then, Matt, if I may, since I just spoke briefly about the electric fund, just to give the committee a quick update. Obviously, that's a 12/31/21 year end. Virtually all of our work is done. I was crossing my fingers that the final product was going to be ready for the committee for today's meeting. But we need just a little bit more time. We're super close, but unfortunately, we just weren't able to get the report finalized for this conversation. But know that audit went very well this year and will be available, in the near future.
Okay.
Great.
So are we ready to move to the next agenda topic?
I have just one question, Scott. May be very simple, or it may just be a typo, or I'm missing something basic for which I'll apologize. Page 167 in the PDF, page 5 in one of your sections references back to net position. If you could pull that up.
This is page 5 or page 167. Yes, and where should I focus?
So first paragraph references total net position 31.
Yep.
682, but then the following references largest portion of said net position is 42.
Yep.
So one would expect a portion of that earlier number to be less, not more, but again, can you help me out?
I sure can try. The 31 million is the total net position.
Right.
If you look at it in the comparative balance sheet here, that's the 31,682 right there. And it's made up of 3 components. The net investment in capital assets, which is referred to in the paragraph down here, that's the largest component. In essence, this $42.5 million is your capital assets less your bonds payable. It's not quite that simple, but generically speaking, that's what that account balance represents. Now, some of the money that exists in again, this is the long-term perspective balance sheet of the school district. Almost $3 million of it is restricted. And it's restricted because it may be grant money that the district received.
Mhm.
And since it's grant money, it's who holds the cards, if you will, on what you can spend that on. It's either the federal government or the state government, maybe somebody else as well. But in essence, the Concord Carlisle Regional School District doesn't control what that money can be spent on, so it's shown as restricted. And since the combination of those 2 accounts, the net investment in capital assets and the restricted net position, roughly speaking, is $45 million, and the total is only 31. That's what produces the negative number in your unrestricted net position.
There you go. Okay.
Yeah,
Very
but
helpful.
I also think it's probably just down to the English language of the notion of a portion. When
Yeah.
a portion is 130% of the total, it's I guess it's just phraseology here.
Yeah, the numbers all worked. It was I was just curious about the way it was framed. Good, thank you.
I appreciate, you folks pointing that out because, I read it all the time, but, but understanding how you read it is probably more important than how I read it.
Yeah.
So I thank you for that. So.
Well, I thank you for your patience.
Okay, so I guess then we'll move to the next topic on the agenda, which is the Concord Carlisle Regional School District audit. And we'll review the draft statement and management letter for FY21.
Thank you. I'm going to go to page 163 of Mary's PDF, and almost everything I am going to speak about with respect to the school district is what we spoke about with respect to the town. Before going through the opinion, I always try to let those charged with governance know that our audit went well, found the books and records to be in good order. The same key estimates that were present in the town of Concord's financial statements are really present in the school district's financial statements. The biggest ones being net pension liability, net OPEB liability, and the related deferral accounts. With that said, the independent auditor's report, again, it's a clean or an unmodified opinion on the financial statements. We do have the emphasis of matter paragraph in here. Nothing is problematic here. It's just telling the reader that this is the first year that the government implemented GASB number 84. Next year, that paragraph will likely say you implemented GASB 887, which is the one I spoke about in the town's management letter on leases. So let's quickly jump over to the school district's long-term perspective balance sheet. And much like the town, the focus really is on these 2 accounts down here, the net pension liability and the net OPEB liability. Just like we talked about with the town, the net pension liability for the school district is $1.4 million. It's a contributing member of the Concord contributory retirement system. which is 95% funded, measured as of 12/31/20. Relatively speaking, it's a very well-funded system. I'm not necessarily going to talk about the pension liability any more than that. All the assumptions that we quickly talked about on the town side of things are present for the school district as well. The net OPEB liability of $9.5 million, as a point of reference, much like the towns came down considerably. A year ago, that net OPEB liability for the school district was $12 million. It's gone down to $9.5 million. And this is the point in time in the town's presentation that I went to the footnotes to see what really happened with that liability. And if we look at the towns, first of all, I want to point out that I talked about this for the town, but for the school district, the OPEB liability is 44% funded. But this is a page for the school district's financial statements that is virtually the same table, if you will, that we talked about with the towns. What happened during the year? You contributed $1.1 million. You had an implicit cost of $600,000. So there's $550,000 in cash that's being contributed to the fund. The fund earned $1.7 million, which is probably a pretty good return on your investment of a portfolio that began the year of $5.3 million. And much like we saw in the town's schedule, these three numbers here, I guess I got a few more numbers highlighted there, but the $940, $945, and $592,000, that all goes back to the assumption changes in the experience changes. And remember, in the town side of things, we highlighted a paragraph that was designed to inform the reader why the experience of the plan was so favorable during the year. And that's the table that I have highlighted on the shared screen right now. So the bottom line is the OPEB trust fund, the liability came down $700,000. The financial position of the trust went up 2.3, and as a result, the liability itself went down $3 million to $9.5 million. So I want to go back to the long-term perspective balance sheet, and similar to the town, the favorable experience that you've had with pension and OPEB produces these deferred inflows of resources, which total about $5.8 million. That will eventually go to zero and amortize out in this credit balance. Again, I said earlier that it's not technically a liability, but it acts like a liability. When this amortizes away, as liabilities go down, net position will go up, and it will improve this negative $13.8 million in unrestricted money by as much as almost $6 million over the next 4 to 5 years. So with that said, I want to hop over to the general fund or the fund basis financial statements, which is page 13 of the print, or 175 of Mary's PDF. And again, the focus here is on the general fund, the first column of numbers, the four different types of fund balance, and the total fund balance of $4.4 million, broken down between $910,000, which is restricted for debt service. $200,000 is a couple of various stabilization accounts, and an assigned fund balance represents about $800,000 in encumbrances and a little over $600,000 in certified E&D. Certified E&D is a school district's equivalent to certified free cash. So about a little more than $600,000 in this account balance is certified E&D that's used towards the fiscal year 22 budget cycle, resulting in unassigned fund balance of $1.8 million. That's up just slightly from the prior year, $85,000 increase. So again, very similar operating results to the town, where the town had a very minor reduction in its unassigned fund balance. The school district has a very minor increase of about $85,000. And again, it's the budgetary results of operation. I'm not going to turn to that page. I just think I don't want to continue to hop around too much. That unassigned fund balance stayed the same because of the favorable budgetary results. Just like the town had favorable revenues and unspent appropriations, but a little over $600,000 of that favorable results of operation were used, so it was set aside for fiscal year 22, resulting in almost an unchanged unassigned fund balance number. Yes, it increased, $85,000, but it's that increase is because of the favorable budgetary results softened or mitigated by about $600,000 in certified E&D used for fiscal year 22. With that, if I could hop over to the school district's management letter, which is page 221. Oh, here's something I did different between the town and the school district. And in the town, I went right to the comments. And in the school district, the page number I had referenced was the opening letter. I'm going to skip down here, but the same concept applies. We do encourage you to read the opening letter for the same reasons we had with the town. And that is, it describes what we did, what we didn't do, and it describes and defines what a material weakness is and a significant deficiency. And those terms, just if you think about those terms, if someone's getting a significant deficiency or material weakness, we're probably going to spend a little more than just a few minutes going through the comment and what we may have found. So none of these issues rise to that level. So just a couple of quick things to talk about here. The first one is a quick follow-up to a prior year recommendation, which was to improve accounting for accounts payable at year end. In the prior year, we had recommended the district establish procedures to properly account for accounts payable at year end and liquidate prior year encumbrances. We've talked about this with the district. The distinction between a payable and encumbrance gets a little blurry, and that's really where the perfection needs to come in. The impact to unassigned fund balance is the same. It's set aside from unassigned fund balance, but the distinction is really important from a GAAP standpoint, not necessarily from a certified E&D standpoint, but from a generally accepted accounting principle standpoint. It's very important to distinguish accounts payable versus an encumbrance. One's a liability, one is a set aside in assigned fund balance. And that's what has become blurry at the school district, and where we think we can continue to make some improvements to distinguish better between invoices that are accounts payable versus monies that are carried forward to a new budget year. And much like the town, we're suggesting you prepare for GASB 87. It's the same concept that we talked about with the town. It's a new accounting standard. And like the town, the school district is going to need to meet with a lot of its folks, and not just the folks in the accounting office, maybe some of the maintenance folks, and see if there are leases out there that meet the new definition of a lease under the standard known as GASB 87. And again, similar to the town, we plan to be reaching out to all clients in the next couple of weeks with another reminder. And we had some in-house training on this yesterday, and we've kind of developed a game plan for our clients to, if they choose to, if they want to follow the game plan that we're suggesting, and we think it will help get them to where they need to be for concluding their June 30, 2022 audit.
Would software subscriptions fit under this notion of a lease or not?
What a great question. Yes and no. And I don't mean to give a confusing answer, but one of the things written into GASB 87 that is specifically excluded is computer software. But I jokingly said this yesterday in our training, like a year later, the GASB, this is my opinion, a year later, the GASB said, hey, wait a minute, we excluded software subscriptions, but we think we missed the boat here. So what did they do? They wrote GASB 96, which is SPITAs, SBIT, subscription-based information technology arrangements. And if you look at the definition of a SBITA, it's exactly the same as a lease. So that's why my answer was no, but yes. GASB 87 says, nope, software is excluded. GASB 96 came in a year later. Let's put we think we missed the boat. Let's put subscription software. And it's all about the recurring payments. Again, that's what rating agencies want to see. What are the governments on the hook for in making recurring payments over the next 10, 20, 30 years?
Okay, thank you.
So I'll stop there, and that's much like the town. That was probably a much faster walkthrough of the school district's financial statements. But in general, the concepts were really the same with the well-funded pension system, the well-funded OPEB plans, and in an almost an unchanged unassigned fund balance, all resulting from the same reasons, which was favorable budgetary results in the community of the school district, using some of those favorable results in returning it through the use of free cash and the use of excess and deficiency or E&D. So I will try to answer any questions on the school district side of things as well.
Well, I guess one of the things that flew by there was you mentioned that the OPEB liability was 44% funded, I believe it was, in the school side. So that's not nearly as favorable as, I guess, the town level of funding. How does this compare with other districts?
Very favorably.
Okay, so 44 is not as bad a number as it looks, you're saying. And the total value was not that big.
Well, I think it was $9.5 million.
Yeah, so it's not that big a deal. Okay.
Matt, I've actually heard idle speculation that maybe districts who are as conscientious as we are will suffer for it because we won't be in line for the state bailout that's going to happen for these underfunded communities someday. But that's again just chatter
So
on the
we should
street.
stop
But
putting money in.
but it does tell us to Scott's point that we're in good shape relatively.
Okay. Great. And then, I mean, I'm just fast forwarding to this year and, looking at those wonderful changes in values. I don't think that we can count on them, for this next year. That I would say we'll be kind of lucky at this point, whether for the investment returns, for example, for the fiscal year will probably come out as a wash for this coming year. So, I think that while we're looking at a really nice set of numbers here, we probably shouldn't get too excited about the future necessarily. That
I think that's a good reminder.
That's actually a point that I was going to raise under new business as to planning for, how we deal with the fact that those numbers are likely, given the last quarter that we're in now for fiscal year 22. How do we see ourselves dealing with that? Because our funding levels will probably drop somewhat, given what the values will be of assets.
Well, I think luckily that the first 2 quarters of the fiscal were equally rosy. So even though this latest quarter has been a disaster, it's probably all going to wash out. But it just doesn't mean, as compared with the past, we're not going to have this wonderful, windfall that we saw in the FY21.
Yeah, what was that? 19% or something? I
Yeah,
forget,
it was incredible for a municipal fund.
Right, but it also could impact our net, balances, right, with the pension and the OPEB quite significantly if it doesn't retain some positive.
Yeah, if we were doing
Darts.
calendar year numbers, it would have been a lot messier. I think that mid-year to mid-year, it's going to be okay.
Well,
We'll see.
point to Arthur's point, it's about planning.
It's not
right?
over
So
yet.
what's the
Yeah,
risk?
yeah. Right, and pretty soon we're going to be into fiscal 23, and that's where this stuff, at least if things
Right.
go the way it looks, is really going to be problematic. So I'm just raising the flag for planning, and this is probably more, there's a staff issue, which I'm sure they're thinking about. We're going to have increased interest rates, among other things. So
Right.
just highlighting that as I'm sure staff is thinking seriously about all of this.
All right, are we ready to move to the next agenda topic then, the audit engagement letter for FY22 through FY24?
Sure.
Yes, please.
I actually don't know how to tee this one up, so who's taking this?
I guess Carrie had asked me to, when we first got this engagement letter, to bring it forth to the committee before it was signed off by the town manager. Carrie, I don't know, if you can share some thoughts, the thinking behind this.
Just in terms of the engagement
Yeah,
letter, so I think, well, I think what we had decided is that in the charge of the committee is actually supposed to review the engagement letter, but I'm not sure the committee has ever done that. And honestly, Mary and I didn't realize that until for whatever reason, we went back and looked at the charge of the committee. And so we would like to fulfill all of the duties of the committee. And so we would like to have the committee provide some input on the engagement letter.
Can I just ask, I don't recall ever seeing prior engagement letters. So I guess my question would be, is there any difference from this year to previous year, last year, for example, with the exception of, I noticed a slight increase in the fees, but other than that, is there any significant or material difference in the wording of the engagement letter that we should be aware of?
There's not anything, Arthur, I assume that was meant for me, but was it meant for Carrie?
Both, actually, because you're the two that go. Well, I assume Carrie has negotiated this with you in her present role. So I guess it's for both of you.
Well, I'll start then on, some of the things that, that might be different in there, and they'll be highlighted through the execution of the audit. Much like accounting standards change, we talked a little bit about GASB 84 and GASB 87. We even talked a little bit about GASB 96 today. Auditing standards change on a fairly regular basis, and every now and then, and the change from the 21 cycle to the 22 cycle, it's almost like there's a whole new suite of standards. So there are some differences, and one of the resulting differences will be some increased communication from our firm to this committee. Generally speaking, we have there's some planning communication, and then this and setting up a timeline, and then this communication at the end of the process. One of those new standards, I can't remember if it's 134, SAS, which stands for Statement of Auditing Standards. I don't know if it's 134, 135. It's which number it is not relevant. But when we perform our risk assessment, where we perform some of our initial procedures, and then Sarah and myself and our staff, we sit around and we talk about where the risk of material misstatement could exist in the town of Concord or the Concord Carlisle Regional School District's financial statements. It's a really exciting conversation. It's super exciting. But historically, that's something we've been doing for 20 years. 20 years ago, the AICPA, or the American Institute of Certified Public Accountants, issued what was commonly referred to back then as the Risk Assessment Suite of Standards. We've been following it for 20 years. So what's changed now? Now that really exciting conversation that Sarah and I and our staff have about where we might find risk in Concord and the school district's financial statements. Now, if we see something that might be risky, even before we come out and do field work, so after we do preliminary work, before we come out to do field work, we need to communicate those risks that we've identified to you. So we've been doing this, all of these things for 20 years. What's new now is now we need to tell those charged with governance about what we may have found for risks. And I will tell you that there's always going to be at least 2 risks. And that's because inherent in the standard, the standard itself says, with very few exceptions, I'm going to kind of use an absolute here, but there can be certain exceptions. But in almost every audit, the standard says there will be 2 risks. One, that management can override its own internal controls. And 2, because of the significance that revenue has to any set of financial statements, the risk that material misstatements to revenue exist is a given risk. So some point in time in the near future, you're going to get a communication from us, and we'll communicate it in a manner that I think will not alarm anyone. But our biggest concern here is all of a sudden groups like yours are going to start getting communication from us kind of in the middle of the audit. We're going to use terms like risks and additional audit procedures to deal with these risks. And it's really, look, if it was something concerning, we're gonna come to you and talk directly about it. But in most cases, it's gonna be just those two standard risks that the standards identify, or, you know, if we see something in the planning phase that we think should be, in our judgment, should be raised to those charged with governance, we need to communicate that to you now. That's the biggest new thing. It doesn't come out and say that in the engagement letter, but that's what the standards will require of us now. And I mentioned this, I think, when we talked about one or both of the town or the school districts, that I said next year the opinion is going to look very different. Again, it comes back to these new statement of auditing standards. I want to say that it's like number 130, SAS number 138 changes the auditor's opinion. So there's all these new SASs for us to deal with, just like you folks have new GASBs to deal with, we have new SASs to deal with. So that's really what's different between the engagement letter. And as one of the folks on the committee said, yes, there's a, you know, because of, for the large part, because of these new standards that we now have to have controls in place to follow, that's really what's generating an increased, the increased fees in the engagement letter.
Thank you.
So I guess this is a question for Carrie. I assume we benchmark the costs of our audit relative to other peer towns, or?
We definitely have looked at that. I think there are reasons that the cost of our audit might be higher than some other communities, although Scott, it probably isn't, even though it probably should be. You know, we have a much more complex organization than even communities that are similar in size.
You mean because of our enterprise activities,
Right, because of, right, all of
regional school district? Yeah, sure.
In one pension plan that is a 12/31 year end, that deals with the town, 6/30 year end, school district 6/30, CMLP, which is 12/31. That, I'm not saying it's super hard, but it's just a lot of balls to be juggled with that process.
And then we have a pretty robust review with this committee, and the number of times that the auditors are making presentations to this committee, and sometimes then going to
The select board.
Select board, but once in a while you're at the select board. So our costs are, I think, very commensurate with the level of work that is
Some
required.
services that we get. Okay. Yeah, by the way, you know, is there any, you know, is a way to us to reduce some of the complexity? Just for an example, you know, with the light plant, just kind of taking the hit and doing a short year to align the fiscal years. You know, it's a painful thing to do, but a one-time thing, and then the rest it gets simpler. You know, we're talking about 100-year-old entity here, so I know that it might not be that simple, but those are the kinds of things that sometimes, hey, maybe we gotta look at.
But there's a lot, with the light plan in particular, there's a lot of state regulatory compliance that
Okay,
it's aligned to, so
so calendar year is essential.
yeah, I mean, I think we would have done it if we could have, right?
Okay.
It's challenging.
I actually like a mid-year fiscal year for the rest of the organization. It's just a lot easier, I think.
Mhm.
Okay. All right. Well, so do we need to take any action on this? Other than, okay, we've reviewed the letter and we're good with that, or do we need to vote?
You know, I read it. I thought it was very comprehensive. I'm glad to hear that Carrie believes that the fees are commensurate and that we've evaluated that. So I'm in support of proceeding.
Again, I think this is under your purview, though, to sign the letter, isn't it, Carrie?
Right.
Yeah, I think we're happy to just present it to you to provide
Okay.
visibility into it. And
So we've reviewed it.
Yeah, and we appreciate the presentation. It's
Yeah.
new and it's helpful for us to know the scope, and particularly Scott's comments that it's getting more complicated with more things that have to be done. And frankly, the increase in pricing is not that much, so.
Right.
Mhm.
All right, then, let's move on then to the audit activity schedule. So I see that is on the last page of our packet.
I can bring it up if you want.
Sure.
Yeah, get to the
I'm
bottom.
trying to reconcile that with what we're doing right this minute in that,
We're a
We're
little.
we're a
delayed.
little off cycle right
Yeah.
now.
yeah, it seems
Yeah.
like it. That's
Yeah.
what
Yeah, I
I'm
think
trying
the
to figure
intent-
out.
Yeah, I think the intent was to say this is what we had sort of pre-pandemic, was sort of the layout of how we wanted to, let me just share the calendar here.
Yeah, it's the preferred schedule, right?
Yes.
Other things aside,
um,
right?
Can I ask you a general question about the schedule? It seems in some past years, receiving
Okay.
materials from the actuaries has slowed things down. Are we doing better on that?
And it
Or
was
are the
OPEB.
actuaries doing better?
And Arthur, that was in particular for the OPEB, correct?
Yeah.
Right.
So are we going to try to catch up in this next year to a more typical type of schedule? I mean, it doesn't sound like we're in a place where we could go 100%, but.
Why not?
Huh?
I guess I would say, why not? We're sort of starting all
Well,
over.
but
again.
here we're in the audit plan. I guess we could say this is our audit plan. We're sitting, looking at it right here. Right? Is that what you mean?
Yeah, I mean, we're sort of, the field work for CMLP is done. We're close to the draft report. Actually, it sounds like we're ahead of schedule on that one.
Okay.
I would
You
agree.
know,
Okay, then maybe, so does our auditor feel the same way? Can we catch up this year?
I think we can make some great strides this coming year. I think I didn't catch who was just talking about it, but I think CMLP for 12/31/2020 is ahead of this, as the field work was really completed at least in May. Maybe some of it was completed in April. But nonetheless, I think draft reports will come out this month, if not right around the 4th of July. And I think that's, again, that audit has gone very well. In terms of the next two, the town and CCRSD, the audit plan really hasn't been, refreshed from prior years at this point in time. Everything so much has been delayed in the last year, mostly because of the federal compliance work that we are required to do. There was a lot of new federal money that was pushed out to local governments, including school districts, and which was great. But from an audit standpoint, the federal government didn't publish what we call the compliance supplement. I think it came out in January of, I don't know, I don't want to say a date, but it didn't come out timely, put it that way. I don't want to say a date because I don't remember precisely, but it was like, came out almost 6 months after the year end, June 30, 21. Actually, as I talk about this, I'm almost certain it came out in December of 21, almost 6 months after year end. And then there were a lot of evaluation of that compliance supplement. In the end, what I'm getting at is the audit program that are given to us by the federal government, or Office of Management and Budget, to determine whether or not entities complied with the federal programs, wasn't available to us and perfected until almost January. So we are a little bit behind in completing some of our federal compliance work, driven by the fact that the federal government didn't publish it until very late. The good news going forward on 22's compliance supplement, it came out last month. And it's much more timely this year, which hopefully will precipitate more timely completion of many things. So,
Great.
In terms of beyond the audit plan, maybe that can get pushed until July, given we're almost mid-June. Field work would be similar to the prior year. I think we've completed the town's financial statements were dated in February. I see that being dated much earlier in the coming year, and would like to do the same with the school district. Someone on the committee asked a question about that past OPEB, or pardon me, valuation reports weren't as timely. I have a copy here for my notes for our conversation today. The town's OPEB report was received on November 29th of last year. So a little bit late, but much better than prior years. And I don't recall, I didn't have the school districts handy to give you the date that was received. But I think there can continue to be a little bit of an improvement with that one, like they can be with the towns.
I'm curious whether from just the select board's perspective, when should we be scheduling the reviews of any of this? You know, first of all, the FY21 audit, but then going into FY22, if there's anything that's imminent, it seems like the light board audit would be, you know, the next one that we would see.
Yep.
So I can respond to that if you want. So the sort of the heavy lift or the detailed review of the town's audit and presumably the district's audit happen at this committee.
Yeah.
And this committee prepares a written report that it approves, and it's that report that gets forwarded to both the select board and the school committee.
Mhm.
And really, that's the only document that has been reviewed. We don't have the auditor go to
To
those.
the meeting. Okay, and so it is very, very brief agenda item typically at the meeting.
Yes.
So, okay, and then that sounds like that would happen sometime this fall.
Well, so Matt, I think that's for you to sort of facilitate, right? Maybe with Carrie and Carrie's assistance, right? So if the report is, it could be drafted now, right?
Technically,
Potentially.
yes.
I know, technically, just saying.
Yeah.
Yeah.
Right, so it's likely that the fiscal 21 report could go to the select board and school committee in August, July or August.
Okay, that sounds about right. And then you know, get a little time to review. So, you know, technically around maybe our September 12th meeting, we would get that. We would put that on our agenda, or August 29th. Okay.
But then Carrie, this committee has to meet and review that draft, right? And approve it
Yeah.
before it gets presented.
Right.
So we need to meet.
Yeah.
Again.
Yeah. So sounds like then we should be meeting again, I don't know, in August or that would
Maybe it's
probably
July. Depends how soon those letters could be drafted.
be written. Yeah.
Yeah.
And the one item that we missed this year or haven't done yet is the annual review of cybersecurity or risk management. So if you have another meeting in July or August, we should look to add that so that you've done it as well.
And
Okay.
then can I just ask one question, looking at the schedule? We referenced that November 29th was when the town received the OPEB. That is still sort of late. And if I look at the schedule, that sort of holds up the ability to get those draft reports done, right? Whether it's November or does it make more sense that we should plan for December? I know that historically we've tried to get this done earlier, but if we sort of look at the standard schedule here, is November still the right target for the town draft report, or should the town and CCRSD sort of be pushed out a month in general? Sort of just a question.
I think the difficulty is from the town's perspective, we're always trying to get the final
Right.
report approved in December so that we can submit to GFOA for the.
Okay. Yeah,
And so
makes sense.
yeah, it's just, there have been some changes in the actuaries firm, and so maybe things will move a little faster than they have in the past.
Yep.
We do.
Is it a new firm or is it the same firm?
No, it's the same firm, but the principal has retired,
Ah,
and I think the
Okay.
principal was the bottleneck.
got it. Yeah, yeah.
Well, all right, then. I think that we will try to schedule something in July for this committee. And then I don't know that it makes sense to try to set a date right this second, but we'll look for a date.
And then will we also, I guess we'll be looking at the CMLP
Yeah,
report also in
At
July.
that time as well.
Okay, it's a lot for that agenda.
Right, the cybersecurity, the CMLP, and
letter,
the
yeah.
draft letter, yeah.
Okay.
Okay, any other business for today's meeting?
No, glad we were finally able to meet. Wow.
This was a
All right.
tough one to schedule.
And then any citizen comments? If so, please use the raise hand feature and identify yourself. Yes, Carlin Reed.
Hi, Carlin Reed, 83 Wits End. Matt and Carrie, I was wondering if you're going to mention to the FAC about the question that came up at last night's select board meeting regarding the evaluation of the auditor's recommendation on the fiber broadband task force and the loan between broadband and electricity. I didn't know if that would play a part in this committee or something else. That's it.
Carrie, could you address that?
Sure. So at the select board meeting last evening, the select board received the final report of the fiber completion task force. It was a very detailed report. It is available on the website for anybody who's interested in reviewing it. The chair of that committee is Mark Howell, who, as you know, is the former chief technology officer for the town and was in the position of overseeing broadband for several years. The task force has raised an issue about the loan that exists between the light plant and broadband. And this group has talked about that before. So as you may recall, broadband was sustaining an operating loss each year. It was, I don't want to say fairly small, but it was relatively small in the beginning, but it occurred over a number of years. And then broadband issued some debt, and that increased the loss, the operating loss. And I think it was in fiscal 20. And Scott, I don't know if it was the auditors that
It was,
that pushed
I recall, yep.
needed to formalize a loan between broadband and the light plant. And so the light board did work on that, came up with a loan policy that was accepted. And the task force has raised some questions about the amount of the loss and the repayment of the loan. And so Scott and I actually talked about this yesterday because I had a detailed conversation with the chair of that committee last week. So Scott and I reviewed that, and he's going to take another look at it and perhaps just put together some information looking at all of those years together and just identifying what work the auditors did to verify those amounts, because the amounts have been questioned somewhat. And so that's going to be a separate audit project. It shouldn't take too. We'd be happy to apprise this committee of the results of that when they're available.
Okay, thank you. Any other public comment? All right, then I think seeing none and that we have no other business, I will adjourn this meeting as the chair. Thank you very much for attending.
Do you need a motion for that? If so, I'll make a motion.
No, we don't need a motion. As chair, if there's no remaining business on our agenda, I can declare an end to the meeting. It's only at the beginning we have to have a roll call vote to notice all of the participants. All right, thank you very much.
Thank you.
Thank you.
Thank you.